wonderful to be able to interview Martí Castany, who's both a talented trader and also data scientist. Martí explains how he incorporates data science techniques into both his analysis of the financial markets, but also to help develop robust trading strategies. He covers the process in detail, from coming up with a new trading idea, hypothesis testing, strategy construction, the use of synthetic data, backtesting, all the way to the point of going live with a new strategy. Martí also shares the one technique that he's found most useful, which he believes will help other traders in their endeavors to become more successful. So, grab yourself a coffee, sit back, and enjoy the interview. It's my great pleasure today to be able to speak with Martí Castany, the trader behind Darwin KLV. Welcome, Martí.
Hi, Martin. Thank you for having me in your show.
Yeah, well, thank you for taking the time today. And actually, we've known each other, haven't we, for probably 6 or 7 years now, Martí, so we're not meeting each other for the first time. And I already know that you use extremely rigorous data science techniques in both your analysis of the financial markets, but also as part of your trading strategy development process. So I, for one, am hoping to learn some really useful techniques from you today. But before we get into any of the detail, maybe you could start off by talking a little bit about your background, specifically in data analysis and data science.
Yeah, sure. Well, first of all, 6 years is a lot of time, and it is scary how fast they have passed.
Indeed, yes, yeah.
So, yeah, sure. So I started, I studied electrical engineering, and kind of my first contact with analyzing time series at that moment were discrete time series, using MATLAB and all this crazy stuff. But I would say that my real background in data analytics came from the real, I've been a self-taught data analytics engineer, let's say, and also from real world working experience. Most of them came from a startup, which actually what we did was to analyze extremely large data sets from brokerage firms to try to predict clients that will become profitable or not in the future.
Okay.
So that was a very nice, it was actually a very fun project. And then, for example, working in a boutique consultancy, in that case, we were doing big AWS cloud-based projects, which mostly involved, again, huge data ingestion and data processing. And they were also beautiful projects where I learned a lot. And it's nice not to kind of put to work real things into the real world and translate this theory that you have learned, in the books and some courses into the real world. And yeah, I would say that that's most of my, because in the early days, I started a company which we were designing high-speed PCBs, like printed circuit boards, which combined both analog and digital circuitry in the same board. And yeah, we did some DSP processing there, but I would say that the heavy analytics part came after that.
Obviously, you've got quite a wide range of experience in time series processing and that kind of thing, and I guess digital signal processing. When was it that you decided to sort of change your focus and your attention and turn your skills to the financial markets? And maybe you could explain how that came about.
Yeah, sure. So it was during the early days in the PCB circuitry design, and a friend of mine was trading American stocks, and he introduced another friend of mine who actually was he just finished law school, and we started being interested in this field because he introduced us to it, and we started trading discretionally. Actually, we were trading crude oil futures.
Okay.
And yeah, just to be honest, making decisions out of thin air and what we thought the market was going to do next based on what it did before, which, I mean, is what everything is trying to do. But we were just, guessing and playing together. That's the truth. Right. And because we had to spend like a lot of time in front of the screen, we had this vision that was traders do. And then we realized that that's what not smart traders do. and we were not smart at that moment. So we were trying to outsmart ourselves by trying to try to systematize, and with that level of risk that when you had to click the mouse button, your finger was like that.
Edge of your seat stuff. Yeah. Okay.
Yeah, by the way, that was one of my best learning when you really trade and you really know yourself and know how things start to go.
Yeah.
But yeah, the problem that we had is that sometimes we weren't, because we were three of us trying to make the same entries, and both of us came up with completely different outcomes with the same data.
Okay.
And that was problematic. And that's where kind of all the things that we did before started to make sense and try to bring that to trading. No? So being able to bring a scientific approach to our decision-making process, to be able first to be systematic in how we make decisions, which those decisions you can then execute manually. There's no problem on that. And then on a second stage, to say, okay, now we know what we have to do. Now let's try to just code this logic into an algorithm that can be executed. And that was like the transition into algorithmic trading, which is what I have been doing since then.
Okay, so you talked about turning this process that you were following into a more scientific process. Maybe you could share a bit more information then about the application of data science specifically in terms of trading strategies. So how do you go about and approach the development of a trading strategy now, incorporating these data science techniques that you had experience in?
Yeah, so the idea was to emulate science. No, so for example, let's say you want to create a new drug. So what is the process that you follow? No, to first develop this drug, test it, validate that it has the outcome that you think or you want this drug to have. So differentiate this outcome from chance, and then put this drug into the market, which is like putting the strategy into production. So it was clear that we needed like a robust framework, a checklist of a process to do in order to have a strategy that we believed and it was robust enough to go into the market. Because that's also that's one thing I learned, that is very important to have a process first by having the process itself and reaching robust conclusions, but at the same time to give you enough confidence to maintain the trading on those strategies if they have a bad time, which they will have. So it's like it has like a double benefit. One of them is you have a robust trading strategy, and the other one is that you have created something that you trust because you know the process you followed. Sure. Which is extremely important, because at the end of the day, you can be as algorithmic as you want, that you always have the power of turning on your server and just switching it off. So that's also important to bear in mind.
Okay. So in terms of the process, then you said there's a number of steps to the process. Maybe you could go into those in a little bit more detail.
Exactly. So everything starts with an idea, and yeah, this sounds very easy, and it's not easy. I mean, you have to have the idea. So the first step would be, okay, so where do we, and I'm putting myself like in that day. So where do we collect ideas from? Which is something that maybe most or some traders could be themselves in. So the first of all was just go to SSRN, the Social Science Research Network, SSRN, yeah, and just search in the academia what things are there that we can start as a source from our idea making process. Okay, so you, for example, can start to download some papers about different styles of trading strategy. You will learn that, okay, there's something called trend, there's something called mean reversion, there's another kind of strategies, for example, like arbitrage. Actually, we developed a triangular arbitrage in crypto, which was a beautiful strategy that only worked for a very small time, but it was wonderful. So you kind of start having some knowledge or some tools to search for. And for example,
so really here you're looking for an idea that's targeting a particular characteristic of the way that
Yeah,
financial markets move. Yeah, they enter periods of trending. They have periods of mean reversion, and it's those that you're really targeting with this idea.
exactly.
Okay.
So now that when you have this idea, okay, you go to those websites or blogs or books or whatever, and you search for, and you have read authors that say that there's trend in the markets. For example, like this paper I have here, just to show it, like, okay, you can see it. It's called 2 Centuries of Trend Following. I mean, you cannot see it, but believe me, it's true. So at least now you have a starting point, and that's exactly what we did, and now what we do right now. So once we know what we need to have, okay, then what we do is formalize an hypothesis. Okay, so markets trend, and then and this is a mistake I made at the beginning, which was just jump into designing the trading strategy, and I think that was a mistake. So first, we have to validate this hypothesis, because that's just an idea that we have. And if this idea turns to be true, then we can construct a strategy around this idea. And this is very important.
Okay.
And that's where the statistics come in. So what we do is just build an experiment with which we can reject or not reject our hypothesis. Okay? And we do it, for example, using, for example, in terms of trend. If you want to test if there's trend in the markets, what you can check is for autocorrelation. Okay, is there autocorrelation also is known as time series correlation? So the past return has some influence on the next return.
Okay.
Or the past 3 or 4 or 5. I mean, it's not necessary to be a Markovian process. It can be like the return 5 days ago has something to do with the next return.
Right. So there's correlation within the time series itself, rather than with a different time series. Okay.
With a lagged version of the time series itself. Yeah, exactly. And for example, if you find it that's true, okay, that's a great starting point for developing now a trading strategy that targets trends. But now that you have kind of verified your hypothesis, on the opposite side, for example, if you want to build a mean reversion strategy, okay, so you need to kind of test what is mean reversion. Okay, so you can just use, for example, you can understand a mean reverting time series as a stationary time series, and then go to your statistics manual or ChatGPT, why not, and ask or search for a test for stationarity, and then, for example, you will find the Johansen test or the augmented Dickey-Fuller test. Actually, you will end up searching for co-integration with 2 assets that, but it's just, you need first the test that confirms that you are going into the right decision.
I guess another thing that this does is it gives you an idea of, well, in a particular market, how often does this, what proportion of the time is it in trend mode? What proportion of the time is it in mean reversion mode? It gives you that kind of information, I guess.
For the proportion of the time, so kind of detecting market regimes, this is a very difficult and very exciting field to work on. It was not most of how much of the time it's trending or is not trending, because the challenge there is, I mean, in the past it's very easy, but now to say if the market is trending or not is way more difficult. But it's just if that trend component was present enough, let's say.
Okay.
To try to capture it.
Yeah.
Okay. And once you have this information, or when we have this information, then we start developing the rules that will try to capture this behavior. So for example, if we want to capture trending behavior, we can use, and actually we use pretty simple rules because we think that are the most powerful, and we try to apply, Occam's razor to everything, but the simplest answer is usually the best one. And for example, what we do is generate a sine wave. This is the one coming from the audio legacy. A sine wave that that it has, actually a sine wave is a mean reverting wave itself, but within that it has trends.
Yeah.
And your rules have to be able to capture those trends. And of course, you can generate a sine wave with higher or lower frequency, higher or lower amplitude. So, I mean, you can, the distance between peaks, you can make it bigger or smaller, and then just the amplitude of the signal, which it's like, it would be a more volatile or not, or less volatile time series. And the challenge there is that once you have the rule or the idea, you have also normally to think about the look back. Okay, so how many data points in the past I take as a reference to say that now is trending and now is not, or that the trend has started or not. And this is also tricky because this depends on the data itself. So usually what we have found is that the best way is just not to rely on a single parameter set and just try a bunch of them at the same time. So trade a bunch of them at the same time.
Okay, but it sounds here, Marty, as though you're generating synthetic data to do some of your development process on, rather than just staying with the the actual real financial data. What's your reasoning behind that?
Yeah, exactly. The difference between like the natural sciences and our science, which is in the financial markets, is that we only have one data source and one shot. I mean, the S&P 500 data is just that data. There's no more data or alternative data. In nature, for example, you can go to a forest and measure tree height, and you can go to another forest, another forest, another forest.
Yeah, there's no limit to the amount of real data that you can get.
Yeah, exactly. So here, the problem that we have is that we only have one data set. And the other problem that we have is that everyone is using the same data set.
Yeah.
Because there's one S&P 500 for all world population,
Okay.
And we all of us have to go to the same place. So this is the first problem.
So you don't want to overuse that data basically in the first instance, which would then invalidate it for the rest of the process.
Exactly, because for example, you can use this data to verify your hypothesis, or pull across different instruments and have like a general outcome of your experiment. But if you then designed your rules into this same instrument, you already know there's trend in there. And actually, you already know from before because you have read in the paper. So you are already introducing some kind of in-sample fitting to your experiment. But there's an amount that you can not avoid to introduce. But yeah, what I was saying is that for us, it's very important to at least all the calibration and design process is not done in real data to avoid any chance of introducing, even unconsciously, anything that we have seen that it works better than the other thing. So we go to this with this one.
Okay.
And there are actually different methods and different degrees on which you can generate synthetic data. For example, a sine wave with some Gaussian noise has nothing to do with the S&P 500, for example. But actually, it's quite similar sometimes to some FX pairs. But then you can have, the real time series and just take a month, take January 2020, then put, I don't know, March 1967, and you can create different time series in that way, which are from the same asset. So it maintains some of the autocorrelation present on this original time series, but you kind of create a new one. Actually, there are a bunch of methods to create synthetic data, but for us is super useful in that aspect that we avoid or just push as much as we can into the future using the real instrument data.
Okay.
And also there's an amount of uncertainty about this data because, and I have a Jupyter notebook that we can explore later to see that.
Okay, that'd be good.
But yeah, that's the reason behind using synthetic data.
Right. So it sounds as though the synthetic data forms the sort of the bulk of the middle bit of the process. So you might, prove your hypothesis on the real data, and then I'm assuming you're then coming back to that real data to do maybe a final validation before you would go live with a trading strategy.
Yeah, usually that final validation, what it looks like is we always try to design general strategies which are not linked to a specific instrument. So, I mean, we are not designing a strategy for the S&P 500 or a strategy for the euro, yen, or no. We design a strategy that then we trade on multiple instruments. Actually, KLV, our Darwin, is exactly the same strategy with only 1 degree of freedom, which is not optimized. So we are trading different variations of this degree of freedom. And it trades 10 different instruments.
Okay.
So, because for us, that's how we understand a robust strategy, and it's our opinion. It could be wrong. Actually, we've been flat. Now we are on the upside again, but we've been flat the last year. So it just how we how we do it.
Right. I guess there's always this balance, isn't there, about, if you're targeting a particular market, you risk overfitting. But then if you generalize more and you have a bigger basket of instruments that you're trading, then you've got less chance of overfitting and more chance of generalizing to the way that markets move, but you might not be performing quite as well. So it's that careful balance of, and I'm like you, I would always err on the side of caution and prefer to have a strategy that maybe didn't perform quite as well, but it performed across a wide range of instruments.
Yeah, the thing that we have found is that sometimes we always have higher expectations than reality can give to us. So yeah, you see a backtest, for example, and you say, oh, that's not good enough, but that's the real backtest, I don't know if I'm, so it's like that, yeah, we prefer to have higher backtests and then filter a little bit more, and then it turns out that wasn't true, that there's, I don't know if I'm explaining myself, but that reality is not that pretty as we sometimes want to think it is.
Yeah.
And actually that prior backtest, which was a little bit ugly, is a much more real representation of what will happen in the future.
Sure. Which is what you want, isn't it? I mean, that's what you want. You want as much realism as you can.
Yeah, but one thing is what what most of traders really want, and the other one is that when they are doing their experiments, they sometimes prefer to see a nice backtest because it can be frustrating to have put, and this has happened to me, a ton of work into strategy, then just to realize it was just pure nonsense. But
Right.
That's our business.
but surely it's better to come to that realization than go live with a strategy that loses money. So yeah.
Absolutely.
Okay. All right. So another thing I'm interested in, Marty, is you've obviously got this fairly rigorous process, which, being data science, I would imagine Python plays a big part in that analysis that you do. So I'm interested in, how do you link together that whole development process with your code and produce, code that executes your strategy in production, in live? And, is there any commonality between those two, or is there a risk of, differences creeping in between those two environments? How do you manage that whole process and that side of things?
Oh, I love that part. Yeah, because it's super important. And infrastructure, most of algorithmic traders tend to forget about infrastructure, but infrastructure, I would say, is like health. You don't have to notice it, but when your back starts to, you don't notice your back until it starts to feel bad, to have pain in there. So infrastructure should be the same. It's there to support you. And you can have the better strategy in the world that if you have a bad infrastructure, it won't serve you anything. So imagine it just keeps on failing. So your results will not be the ones that it's supposed to be. So this is a crucial part. We started our journey with MQL4. That was painful, but because we were used to code in C++, it was not, that different.
Sure.
Then we shift all our infrastructure into MT5, so MQL5. So sorry, MQL is the MetaCode's language. Yeah. So MQL5 was from the language from MetaTrader 5.
Yeah.
And Yeah, we made a huge step there. All our strategy research was done in MQL, some in Python, so that was kind of painful. We created a system in which we just wrote to a local SQLite, so an SQL database, all the results that were taken during a backtest and then processed that in Python. But it was a nightmare because, you know, research code and production code, they were so different. Sometimes when you move your research code into production code, you can introduce mistakes,
Yeah.
human mistakes, and things that you have. Because, sometimes in production thing and in real time, things work a little bit different that you might sometimes think or expect, or you just forget about applying something.
This is exactly why I asked you the question, because getting that right is so important. Yeah.
So it came the moment where we had to realize, and actually that's not only myself. I mean, we are a team of incredible people from whom I'm learning a lot. It happens just to be me today talking with you, but we are a team, and we decided that it was the time to just stop having, because we were subject to the risk of meta quotes shutting down their platform, for example.
Mm-hmm.
And it was enough for us. I mean, we just decided, okay, now it's the time. We cannot keep on doing and working like that. If I do something in the code and then some colleagues want to change the code, I have to share the file with them. That's just nonsense. So we decided to build our own trading infrastructure, and we spent 6 months creating a proprietary event-driven backtesting framework and live trading framework. The good thing is that this thing now lives on a Git repository, so different parts of the team can work on different parts of the framework at the same time. We have created this so it's super easy to use for the researchers. So, for example, if you want to create your own strategy, you just branch out from our develop branch, and then you have all the infrastructure for you, and you just have to focus on the strategy design part. But the most important thing is that with this tool, we have exactly, and when I say exactly, I mean exactly the same code for research than for production. We just change a decorator on the function calling, and then it goes live with some checks, of course.
So it's 100%. It's 100% the same. So you can guarantee that if you've backtested, okay.
Exactly, and actually that was I would say, a beautiful exercise, because we had to develop an execution engine from the ground to simulate everything that happens inside a pairing server, which has been an amazing experience by itself. And everything is done in Python. We are now starting to use Python to try to speed up some parts. We have thought to use Rust or C++, but just in our opinion, right now, it introduces an amount of overhead that is not, I mean, for the amount of performance gain that we would have is not that beneficial, because we trade on a small to medium frequency, so we don't need that much speed. So, at the end, having to build and think and building your own tools, like as I told you, the execution engine, that you're actually mimicking how a matching engine would work, and you have literally at your disposition an exchange only for yourself to send your trades to and get responses, the same way as we would have in a real scenario. It's very useful. And for example, for other members of the team, they just don't have to care about what's behind and how it works. They just care about the strategy part, which is exactly the same that they would do if they would be trading in using another infrastructure. Also, the beautiful thing is that because we've used some paradigms of design, it actually, for the trader, it almost doesn't care if at the end you're sending your trades to an MT5 endpoint, to a fixed API, or just to a REST API from Binance, for example. Because we've designed our system to make sense on its own, like as a core. So we are using a concept called architecture, hexagonal architecture. And I mean, we have our own objects, our own definitions, our own risk manager modules, our own position sizing modules, and everything fits together like Lego pieces.
And it's decoupled from the actual
Absolutely
data.
decoupled. Exactly. That's the perfect word. It's decoupled.
Yeah.
Effectively, it's decoupled. And yeah, so you just generate a trade as our framework says you have to do it, and then you don't care if it is sending to the simulated exchange or to the real exchange. The same happens with the data.
Okay.
Because of the design itself of the framework, it's impossible to commit look-ahead bias. So it's impossible to get access from data from the future, even during a backtest, which is something that if you vectorize your backtests, it's extremely easy to do, to use data from the future.
And I guess that's an advantage of having the same code base, because if you try to do that in production, obviously it would throw some error because you can't look into the future.
Yeah.
So you know that it doesn't have that look ahead bias, and therefore you have confidence that it doesn't have it in backtest either.
And it has another advantage at the same time, is that it's provider agnostic. For example, you can run everything as a Docker container in a server, or you can build a really decoupled infrastructure in AWS, for example, using Lambdas, SNS, and just Kinesis, for example, for the streaming of data. So that's the beauty of that yeah, we have deployed a lot of time and resources to build this, but it's just because we have put ourselves 10 years into the future. And I think, I mean, first of all, it's an statement to say that in 10 years in the trading business, you will already be there. So that's the first part, which we hope we are. But at the same time, yeah, it positions ourselves to have the tools and all the needing parts to make life easier, and just putting by design all the good practices that we have learned, and by code making some mistakes to be impossible to make. You know, there's always some margin of error, but that was a little bit the idea behind that. And thanks to this framework, now we are able to develop strategies that it were impossible for us to develop before, and that's super nice.
Okay, fantastic. So what you've explained is, I guess, quite a broad and extensive use of data science. But what I'd really like to do now is to really, I suppose, get a tip from you. Okay, so some of our viewers, and myself included in this, we probably don't use data science to the same extent that you do. So do you have any suggestions for maybe one key area of data science that people like us might start off with? So an area that, could hopefully quickly have an effect on our success as traders, that you'd really pinpoint as being, a good starting point for someone who's looking to get into this area of data science.
Yes, I would say that there's a concept that it actually is the one that has helped me maybe not, yeah, I would say the most, or one of the top, three concepts.
Okay.
That is the concept of uncertainty, and how to measure uncertainty around all the metrics that you derive from an experiment, and also using this concept of uncertainty to help you aid your decision process.
Okay.
Because and I will explain now, and I already have some code prepared to show some nice graphs to kind of visually see the thing.
Yeah,
because,
please share your screen. That would be good. Yeah.
But just before sharing, is even if we are, so all the decision-making processes are automated when it comes to trading and computing the amount of, the number of contracts or stocks or lots or whatever. So the position sizing, everything is automated. There's at the end also a layer that we have to put ourselves as portfolio managers for the strategies, and are the risks, for example, the weights of each asset that we trade. For example, if you trade, for example, now we are trading an ETF called AAXG, which is all Asia except Japan.
Okay.
That it has already 30% weight in China, but we are already trading MCHI, which is an ETF from China, and another one from India, which already has exposure in that. So there are decisions that you have to make at the level of the portfolio to decide in which assets you trade. Those ones are easy because, I mean, you already know that, okay, if this ETF has already 30% in China, it's very easy to do the math to know how much of the other one you need. But if you look at performance, it's not that easy to choose between, okay, I will trade that instrument and not that one. I would usually trade the two because using this measure of uncertainty has helped me decide and see that I cannot, statistically speaking, differentiate between the past returns of one instrument over the other within that strategy. And what I can do is just put a little bit more weight in that one and a little bit less in the other one, but never choose one over the other. And that's the concept that I want to show you. And for me, is one of the concepts that has helped me, kind of the most on being able to decide on things. Okay, so I have prepared, it's just a small notebook. I have already executed some cells like this one for getting the data from a local SQLite that I have on here. I have copied on this computer. And it's just a database that we have actually in the cloud, but I create a small subset here to make it to be able to use it. Maybe I can do a little bit of zoom. So yeah, just a database with minute precision data. Important things. Let's go to the graphs. So as we have seen, for example, now here we have two instruments, the euro and the sterling pound versus the US dollar. Perfect. We can see them here. Nice.
Okay.
But there are other things. And the thing is that, when you have a time series, and this is not important, when you have a time series, what we usually try to do is to think that this is the result of a process coming from an unknown model. And that's actually the only thing that we have is regarding to the conversation we had before. So all the traders in the world that trade the sterling pound only have this realization of the path that this instrument has taken.
Yeah.
It's the only one that we have. And actually, what we can do, for example, is estimate this model. In that case, is using a kernel density estimate, which is a super fancy word to just put discrete data into a continuous shape. So it's just that, but fancy words. And we see, for example, that.
So is this plotting the returns at every time step, and basically?
Yeah, this is just the returns distribution.
It's just a
put it
okay, yeah.
Yeah, into fancy words, and just doing an estimate to plot it in a continuous fashion, not in a discrete fashion.
Okay.
It's just to see it visually. So the point is that when you see those two distributions, so our estimated models that drive those return streams, and this is a small data. It's from, I think, just 1 second. I think the query I have here is from, so it's from 2016 until 2023. So okay. I mean, it's not a lot of data, but the idea is the same. We actually cannot differentiate those two time series models. We can see that, the kurtosis on one is higher than the other. Kurtosis is, how
spread out,
pickier and no tails it has. But as you can see, both of them are centered around a mean of 0, kind of have the same standard deviation or same risk in this time period. So the thing is that you cannot really differentiate those two estimations of this model. And this is something very important because actually, we can create also other models. In that case, this is making the assumption that it derives from a Gaussian distribution, whatever. This was nice in my head when I was preparing this, but now it's not useful. But the important thing is that you cannot differentiate between them. And what does that mean? That means that, for example, and let's do it in real time. This is just the code for creating, using the mean and the standard deviation from the euro dollar in that case to create different time series coming from that estimate of the model. Okay.
Okay. So this is the synthetic data that you were talking about.
Yeah.
Yeah.
One of the kind that synthetic data that we can create. So it's because I have not much real estate space in my screen. So it just that's what the code does. And we are generating 5 series. It's enough for now. But if we just start, playing with that, we can see that each time, even if everything is coming from the same model derived from the euro-dollar real one, this is just to say that there are different paths that reality could have had.
Okay.
And we have only seen one of the paths, which is the blue one, which the thicker line.
Okay.
So the concept is that, we only had one realization of that, but we could have had another one that could be derived from exactly the same model.
So this is where the uncertainty is coming in.
Exactly. So this is to understand, because then this idea, we apply that to a backtest, for example.
Okay.
So this is just to demonstrate. And you can see them how similar they are. So it could be another instrument, and you can believe it if I show you time series.
Yeah, if you didn't know that it was synthetic, you might think it was genuine price data.
Exactly, and everything here is synthetic in that aspect, except the blue thick line. So yeah, that's the backtest part. We are going here now, but the important point here is to understand that one thing is what you see, because it's the only data that has realized, but it could have been another way, a completely different way, and it's statistically it's valid. And for example, you can also extrapolate that from now on, the new curve could be perfectly the purple one.
Yeah.
The thing is that also when we create scientific data, we are using a sample to estimate the true parameters of the real model. But it's the sample. It's not the full population, because we don't have access to this data. So there's always uncertainty around everything we do. And even when we try to quantify uncertainty, there's more uncertainty around this quantification.
And this all comes in because, the nature of the markets is that they're, I guess, predominantly stochastic, they're random. And, this is something that every trader has to deal with. I think you've gone into it and you've sort of quantified that to some extent. But it's something that every trader has to deal with, the fact that there is this randomness in the market. I guess the key to success is, can you work around that randomness, looking for, the non-random elements in order to take advantage of those to make a profitable trade?
With that idea in mind, we can go to the next part to answer exactly this question. And just one other thing, that you can do everything perfectly and just have, hit the real button, start deploy your code into production, and just have bad luck going into the future. Everything, even if you have done already perfect and your strategy is robust, you could have bad luck. So yeah, because of this stochastic nature, there's a component of luck that it's there. Of course, as the longer the time you are exposed, the less luck that you have, and the more skill that you have the skill survivorship bias that it will last. But so we have to bear that in mind. So, okay, so now with this idea in mind, this is just reading a CSV of a backtest that we have done using an out of sample walk forward process. And the idea is that this same idea that we have had, and we have kind of demonstrated with this synthetic data, is that we can apply the same idea with a backtest. Okay, so for example, I don't remember if I have loaded or not. This is just because of a execution from before. So yeah, let's do it again. Here we have the backtest. Okay. But now imagine that this backtest is like the thick blue line here. We could have a lot of different realities from this backtest. Because this backtest, we can understand this backtest as just the realization of an unknown model. And arrive at this point, this means that we have follow the best practice to create a backtest, because if this curve is overfitted and we have not did a good job creating this backtest, all the information that we will derive from this will not have any value. So we can just throw it away to the bin. So this is also very important. So given that I assume that we have followed best practices here, and the idea is that what we can do is follow a process which is called non-parametric bootstrapping with one S. And again, another fancy name for a process which is stupidly simple. But what we will do with this backtest is take it and dissect it as each individual trait or each individual return of the day, wherever the sampling process you are following. And we will create, in that case, 10,000 simulations of the same backtest. All of them will have the same length of the original backtest. So if I have 1,000 returns, we will create 10,000 simulations of 1,000 returns. And the most important thing is that we will sample them with repetition. Again, don't worry about the code. This is just a code using NumPy to make this thing blazingly fast. You will see it right now, actually. But the idea is that we'll create different paths from our backtest using the only data that we have, which is the backtest data itself. So, and that's why I said that if the backtest has not been done properly, all the things that we will derive from this backtest will not have any sense. So just let me just comment out this. No, actually, that not. I want to plot. And we will just do 100 once because we will plot that. And if not, my laptop will explode. Yeah, already done. And just plot them. I have them here. And here we have those 100 alternative paths for this backtest. Actually, I had this prepared. It's a blog post that I wrote in my blog. I'm sorry, it's in Spanish, but there were some pictures that make it super easy. That's exactly what we are doing. So we have this original backtest with those results, and we create a simulation. And it can happen that with this simulation, we randomly choose, okay, from the original backtest, but we can choose the same one different times. So that's the definition of an image is worth 1,000 words. So we have those number of simulations, and we measure the Sharpe ratio, and then actually it's what I'm going to show you now on the code. But with that, we can create a distribution with the different Sharpe ratios that we have created with those synthetic repetitions. And that's exactly what we are doing here. But using this data, as you can see, there's a super outlier here, and there's another one. And this is also very optimistic because there's a component of overfitting in this backtest that actually there should be some numbers on the negative territory. Actually, we have only plotted 100 iterations. Now we will do the heavy one. So it could be that just because of poor chance or luck, there's have not been anyone which is negative. But the idea around that is to visually see that we can kind of imagine ourselves a distribution, here plotted, I don't know if you can see my mouse, but plotted in that way where you can start to see the amount of uncertainty that is around this measure. So if I measure the Sharpe ratio of this backtest, I think it was like 0.4, which is pretty optimistic. It could be true that, that's the measure from my backtest, but I need this measure could be distributed around. So if you have this 0.4 backtest, this is the result of this specific realization of the backtest. But how sure I am that my Sharpe ratio is 0.4 and not 0.3 or not 0.6? So with that way, we are creating a way to actually measure this the uncertainty around this measure. So for example, I can then take decisions on which I say, okay, so there's a real chance that my Sharpe ratio is actually way lower than I was expecting using this backtest, and I have that chance that this really is that, so that my Sharpe ratio is really 0.2 and not 0.4. Now to go to the fun part, let's just comment this out because this is just for plotting purposes, and we will do, I don't know, 100,000 simulations, And for example, you see that, yeah, this will just take 20 seconds, which, I mean, is pretty fast. So at the same time, if everyone also always tells you that Python is slow, the reason is that you're not using the right libraries or modules. But yeah, we have already done these computations. This now is useless, okay, whatever. And now what we are doing is to plot the sampling distribution, and then just let me comment this out right now. The sampling distribution of this backtest. So now just imagine that we have all these backtests here, which are derived from the base backtest. And we measure Sharpe ratio in this is, I don't know, that could be a 4. For this is 3.5, for this is, I don't know, for this is whatever, 0.44, and this is 0.01. And we count and we take note of all the Sharpe ratios of all the different backtests. And with that data, which is actually what has happened here, so we have a NumPy array with all the alternative Sharpe ratios, and we use this data here to plot it in a kernel density plot from, as what I said before. So yeah, let's just execute that. And here we have the sampling distribution of the different Sharpe ratios. And now I can kind of have a sense of the uncertainty around this measure. So the backtest of this Sharpe ratio, the Sharpe ratio of this backtest was 0.43, which is a little bit optimistic, but yeah, it's what it is. But there's a chance that it's actually 0.2, that the real trading strategy has a Sharpe ratio of 0.2.
Sure.
There's a chance. It's small given the data that we have, but it's possible. So if in the future you have this Sharpe ratio, in theory, it's not probable, but it is possible. But at least you have now an idea of how much variation you could expect around this measure. And then the future could be nothing like the past. So we are also subjected to this stochastic nature that we were talking before. But the idea is that with a high enough number, we can actually compare, and this is given, so this is due to a thing called central limit theorem. We can extrapolate this curve as if it was a normal curve, okay? A normally distributed distribution, let's say. This line of code will also create a normal distribution using the mean of the alternative Sharpe ratios that we have calculated and its standard deviation, okay? So a normal distribution needs a mean and a standard deviation. And we will create that one with 250,000 samples. If we plot it, we see that they are almost the same. And actually, the sampling distribution of the Sharpe ratios and the normal distribution using the Sharpe ratios mean and the Sharpe ratios standard deviation. And this is only to demonstrate that it works. So now that we know that this can follow a bell curve, what we can do is just zoom or zoom the area, so integrate the area under the normal distribution curve to try to ascertain which could be the probability of having a Sharpe ratio actually lower or higher than one of these numbers. In that case, I put here 0.5, and it's these numbers. Really, this backtest has a little component of overfitting here. So normally you would have, I mean, if I put here probability of having a Sharpe ratio of 0.1, it's not. This is more probability. It's way higher. Okay, so this is an overstatement. But I hope that the idea is here. So, and with having that in mind, if you have the returns from one asset, euro dollar, and you have the returns from the other asset, once you have applied your strategy, so my strategy on euro dollar gives me this return stream, and I do this process and I plot it, and with the pound gives me these results and I do this process and I plot it, if you compare them, probably both of the distributions will coincide. I don't know how to say it. Will be one on top of the other. If they coincide, you cannot statistically differentiate between them. But if they are, then you can start saying, okay, so this instrument, I can assure that at least in the past, I have an argument to say that I can allocate more capital in this instrument and not on this other one, because even having into account the uncertainty around my measure, one is better than the other. But if they are not, it would not make sense to discard one in pro of the other, because you have no way of separating them. So this is actually what we use to decide or to aid our decision process on how we assign the weights on the portfolio level. So for example, if we trade FX, or one part of the portfolio trades FX, we usually allocate equal weight to each one of the FX pairs. But if one of them is statistically different than the other ones, then we can, or we make the decision to give it a little bit more weight. But
Sure.
It's not mandatory.
Okay.
So I hope that was the idea to transmit. Hope that makes sense.
Yeah, that was really useful. Thank you for that. And it's good to see some of this in action and see the code and what you're actually been talking about. So we'll start to round off the interview. I think I've just got two very quick questions, Marty. So the first one is, in your opinion, what do you think distinguishes successful traders from others?
I would say perseverance. Yeah, and patience.
Yeah, I think I agree with that. Mm-hmm.
Yeah, being able to cope with uncertainty and frustration.
And still carry on. Yeah.
Yeah, and just having that determination, because this is, it's tough. It's one of the toughest industries in the world. High reward, but it also has this high risk. And yeah, just be curious. Don't have a rush. And if you need to step down and learn a concept before applying it, do it, because on the long run it will help you. And this is a long run thing. It's not just one trade and be rich and all that nonsense.
And the great thing about coding this is that, once you learn these things and you get them coded into your framework, you've got them then for the rest of your career, basically.
Yeah. You compound on your technology.
Exactly.
Yeah, just one other thing very quickly. Surround yourself with more intelligent people and that have different opinions than you to stress test your opinions and your processes.
And to challenge.
So just don't be alone. Work with the team, and that I think also differentiates successful traders, or at least helps you become. It's easier to be successful with the appropriate team.
Sure. Yeah. Good tips. Thank you. And then the final question. What are your plans for the future now? For example, do you have any improvements you have in mind to make your process better, and to help with performance in the future?
Yeah, we are improving our framework a lot. Now we are designing a new way of performing the wall forward analysis testing, which also we have implemented in the framework. The idea is not to do the typical thing that you put like 1 month of training and then 1 week of out of sample, and then you move the window. So you have this fixed window. But we are using a test called Kolmogorov-Smirnov to differentiate the return distributions of the underlying asset. And when the difference is statistically significant is when we retrain the model. So it could be that we maintain the same parameters during, 3 months, and then we retrain during each month, and then again 3 or 5 months, and then retrain.
That sounds good. Okay, so I'm going to round up there, Marty. If anyone has any questions or wants to get in contact for any reason, is there any way that they can do that?
Yes, we have a contact form in comalogic.com. Okay. And yeah, that would be the primary way. If not, on LinkedIn or Twitter, maybe on LinkedIn would be the best way.
Would you be okay if I put a link in the description?
Yeah, sure.
Okay, that's excellent. All right then, Marty. Thank you ever so much for your time today. It's been an absolute pleasure, and I've learned lots. So thank you very much.
The pleasure was absolutely mine, Martin. Thank you very much.
Fantastic. Bye for now, Marty.
Bye.
Bye.